Well, hello. Welcome to the video of this mailer that you received in the mail. I am your host and narrator, Josh Thomas. Let's look and open this mail piece together, shall we? What a good looking young man up there at the top corner sending me. It's so kind of him to send me this stuff in the mail. And first class home mortgage, equal housing lender. Good people. Good people. What's on the other side? We got some jokes here. It looks like, are these funny? Did I make you laugh? Why do you spell dark with a K and not a C? Why do you spell dark with a K and not a C? Ooh, I know. Because you can't see in the dark. Did you know humans eat more bananas than monkeys? I mean, who eats monkeys anyway? Guys, I included these jokes because they made me laugh, literally. So I know they're sometimes really dumb, but some of my funniest jokes that make me laugh the hardest are the stupidest. Like, what's red and not very good for your teeth? A brick. What's the difference between, what is it, a plum and a rabbit? Nothing, except the plum is purple. Um, I don't know who made these jokes up, but they make me laugh. Why? What kind of exercises do lazy people do? Diddly squats. Before you criticize another person, you should walk a mile in their shoes. Then, if you make them mad, you are a mile away from them and you have their shoes. Love that one. If you have 5 apples in one hand and 6 oranges in the other, what do you have? Very large hands. So, and let's open this up. How many apples grow in a tree? All of them. Duh. All right. And by now you've opened it up because you're watching this video, which already you're probably starting to regret. What did I get myself into? So let's continue, shall we? What should I, or when should I refinance? Usually when the market offers a better deal. So like if their interest rates are about 0.5% lower or something, that's usually a better enough deal for people. Or if you have debt besides your house and you have enough home equity to consolidate it, this can be a very powerful time to refinance as well. So even if your rate goes up, but you're consolidating debt, oftentimes your overall net rate goes down. We actually spend time giving people what their blended interest rate is so that they can kind of see past all the surface level rates. Um, in both cases, we get you quotes first, which include estimated costs, recoup time, and long-term benefits. If we wouldn't do it ourselves, we'll tell you that. You should know that about us by now if you don't. I've definitely been known to talk people out of refinancing because it didn't make sense to me. Some people have refinanced anyway, but I will let you know if I think it's not in your best interest. And I don't usually push very hard. There's a once in a while where it's like a blatantly amazing deal, a no-brainer, and then people aren't taking action. I might get a little pushy on that one, but probably more like persistent or even annoying more than pushy. How much does a new buyer need for a down payment? So VA and USDA have no down payment requirements. So if you're a veteran of the U.S. military or if you're buying in a rural housing area, no down payment is required. So zero down. FHA requires 3.5% down. Fannie Mae, Freddie Mac, which are the conventional loans, require 5% down unless you qualify for the affordable housing, and then it's only 3%. Let's see. We also have lots of down payment assistance. So what I already discussed is the baseline, but we have down payment assistance. So if you don't have the 3% or 5% or 3.5% required, ask us about down payment assistance. There's a lot of options. We also, let's see, of course, remember the closing costs. There are closing costs for mortgages. They can feel like another 1 or 2% of the price, but in a lot of cases, sellers are paying those right now. So you absolutely do not need 20% down. It is something like 80, I can't remember the statistic now, I shared a while back, but it's something like 80% of renters in the United States think that they need at least 10% down. That is never the case. I just told you there's every loan that I offer is not 10% down. We have a few loans that are 10% down minimum, but those are like self-employed and I write off all of my income on my taxes, but I give bank statements for income. I can still get a mortgage even if I'm showing zero income on my taxes, but that income, that type of loan requires a minimum 10% down. But that's like the only types of scenarios we have that are minimum that. Unless you're buying like rental properties. Rental properties definitely need some more. Okay, what's an APR versus other rates? Sometimes people see APR and they're wondering what that means. So APR is the interest rate that you're actually talking about plus closing costs and mortgage insurance. That's kind of folded in. So APR includes closing costs and MI over the life of the loan and recalculates the rate to show the consumer what those costs are. Unfortunately, the math is easily manipulated and is only the token rate. Regulators never enforce its accuracy, thus it's rarely actually accurate. The other rate, that's what we call the note rate. The note rate's the actual interest rate calculation. So if you have a 6% rate, it's 6% of your loan balance is what they calculate your interest from. That's it. So that's what we call the note rate. The APR is where it calculates, it adds in your mortgage insurance, your closing costs, and other things like that to try to give you a more accurate read on your actual finance charges, if only it were accurate. That's about it. So if you click on that QR code at the bottom on the right side, I actually have a web page I've been building out with just a bunch of common questions that first-time home buyers have. So parents of future home buyers, or even just any home buyer, if you want to kind of get a refresher, there's some life hack payment options in there, like ways to get lower monthly payments. That's a big deal. All right. So from the desk, Josh Thomas sounds like a smart guy. He says, thank you. I know you guys each hear it from me all the time, but I mean it. Brandon and I provide for our families thanks to you. We try our best to be the very best option for you with the most experience, the most capable and fast 2-week closings, super cheap rates, and financial education after closing. But in the end, you still have to choose us, and you have. So thank you for coming back to us. Thanks for telling your kids about us. Thanks for having your neighbors and your friends call us too. We just wanted to let you know we appreciate you so much. Man, that guy sounds like a super gracious guy. And look at him, he's so good looking. He looks so young in that picture versus older images of him. Okay, so a couple of success stories in here. How do I choose just one? We made someone $150,000 the other day. Want to hear about that one? That's kind of a big deal, right? All right. So a client recently bought a home, and we were only, and they were only able to get an 8% rate at the time. They purchased the home as a second home. They weren't able to purchase it as a primary residence because they weren't moving in right away. 8% rate scares a lot of people away, but not them. They were able to do it. They were brave and did it anyway. So last winter, we were able to offer them a 6.8% rate for only $2,900 in closing costs. So it saved them $386 a month. And I know that's almost coming up on a new car payment. Well, more like an old car payment. But this is where it gets interesting. This is where I like to geek out personally. So if they refinanced and kept paying the same old mortgage payment, so they refinance down to 6.8, they save $386 a month. But if they don't pocket that 386 and they actually keep making that same old monthly payment to the new mortgage, that's $386 a month cheaper. If they did that, they would actually pay off the mortgage 7 years early, which would save them $106,000 by that point in the loan. And a lot of people look at that kind of stuff. That's where I get all these questions about biweekly payments and 15-year mortgages and stuff. It's the same idea. You're paying a mortgage off. You're saving yourself tens of thousands of dollars, if not hundreds of thousands. And that's amazing. That's an incredible experience. And I do think they could have figured that out on themselves. A lot of people figure that out themselves. But this is what I do. This is where what I love came to light. So I showed them, yes, if you pay the $386 to the mortgage, you will pay it off 7 years early, and that yes, that'll save you $106,000. But what if you don't pay that $386 to the mortgage? What if instead of paying it to the mortgage, you invested it? And I'm not talking about crazy like hard investments. I'm talking about opening a mutual fund, just grabbing a mutual fund of some kind and putting some money in there. Mutual funds usually tend to be pretty conservative, pretty safe. They'll have fluctuations, but they tend to be a lot less because they're diversified in all kinds of different investments. So if they just chose something conservative, by the way, if you're listening to this and you're like, yeah, I want to do that, but I don't know who to go to. Most people have a 401k or an IRA or something like that. They have financial advisors tied to that. Well, you can reach out to that financial advisor and ask for a mutual fund. They have access to it. But if you want a referral from me, I definitely got some awesome financial planner friends that are just amazing and can certainly guide you to this and better. So anyway, let's assume they invest the $386 a month in the mutual fund, and let's say it averages 7% per year as an average rate of return, not higher, but not lower. Then not only would they be able to still pay off the mortgage 7 years sooner and save that $306,000, but they'd actually, so 23 years down the road, they have a chunk of money in this mutual fund. They cash out a chunk of it, and they write a check to the remaining balance of their mortgage. They do that, their mortgage is paid off at year 23. But how much is left over in that mutual fund? They have, at that stage, they have $156,000 So they paid off the mortgage and they saved 106,000 by paying it off, but they still have 156 grand in that mutual fund. So paying it early saved them 106 grand, and then doing it this way actually put another 150 grand in their pocket. That's the power. That's what we do for people. That's why I love what I do. And so, like I said, if you don't know where to invest that, let me know. We can get you a referral. 3 other quick wins. So since last fall, 3 separate clients. It's actually 4 at the writing this email now. They wrote offers on homes for sale. They got their offer accepted because they were able to close in just 2 weeks. And so because of our efforts to be able to get people closed in 2 weeks, frequency and abilities to do that, 4 of my clients own their homes and were able to purchase their homes and be the new owners of that home because of our 2-week closings. And I just love that. I love that we are able to do that. I also noted that one of them, it was in December, we got our loan closed. We actually had our clear to close. We were ready to close the loan at day 6. Federal law requires us to wait until day 7. And so we actually had to wait on federal law. We were already ready to close at day 6. So that's kind of fun. All right. Wrapping this up. Hopefully you guys are listening to this like on the way to from something or whatever, podcast or whatever, but there's nobody else in this podcast with me. We don't have a microphone. So there we go. Now that I have the microphone, now it's a podcast. Just kidding. Now you can watch it while you're commuting. All right. Are reverse mortgages evil? Oh man, this is a hot topic. I am surprised at how frequently this conversation comes up. Literally multiple times a week. I'm having this conversation multiple times a week with people. So if you have parents, or if you are parents, if you're 62 and older or coming up on that, listen carefully. Don't hate on reverse mortgages. They have a place. It doesn't mean you have to get them, or doesn't mean that you have to like them, but make sure you understand them, because when you understand them, there's really not a lot to dislike. Reverse mortgages. So you have to be 62 or older. But what they do is they remove the monthly payment for life. And they're exactly like a regular mortgage in the way that they attach to the title of your house. They do not take ownership of your home. Not now, not ever. They defer the interest that accrues each month. So this means the balance increases. So there's no payments due on a reverse mortgage. You may owe 100,000 or 500,000 or whatever your current balance is that you refinance. You owe that amount, but you don't owe a monthly payment. There is interest accruing, but it's accruing and adding to the balance, which is where some people get a little freaked out. So this means the balance increases every month by the interest amount accumulated that month. But that's not the amount of month that the amount of payment that most people are paying. Most payments include the loan, the principal and interest part of the loan. So it's just the interest portion that's going to defer. Most people have mortgage payments that include taxes and insurance and mortgage insurance, but none of those are included in this. It's just the interest that's being accrued. So it's not as big of a chunk of money as people think. But the balance, okay, so the mortgage balance caps out at 95% of the value of the house. So if for some crazy reason your house stopped appreciating in value for the next 15 years, but you were on a reverse mortgage that whole time, then your balance is going to go and eventually exceed the value of the house. Well, it has to cap around 95% of the value of the house. So at that 95%, this is a non-recourse loan, meaning the bank has no recourse if something goes wrong. So they give you the loan. Once they've given you the loan, that's it. They can't retract that. So even if you're upside down, they can't call the loan due. Even if, in any situation, they just can't call the loan due. And so you make it to 150, your balance just keep going all the way until you're 150, right? Regardless. But when it comes time to move, or you pass away and your heirs are trying to take care of the property, if you're upside down, which I'm going to hit that in a second, but if you're upside down, then they are able, the contract reads that they are able to repurchase the property in their name, or refinance the property actually, at 95% of the current appraised value. If somebody wants to continue to live in it or something like that, or if you're selling it, you're still alive and you're living in it and you're selling it because you want to move somewhere else, you only have to pay off 95% of appraised value. So even if you're upside down, it doesn't matter. But understand that the banks pay their smartest people they can get to make sure that you're never upside down. So they loan you a small amount of your actual home value. They loan you a pretty small amount of that. And the idea is that whatever amount of equity you have today, you will always have. And the reason why is because the home value is going to appreciate little by little as the loan balance also increases. And so this chunk, as the loan balance increases, the home value tends to increase also. Does that make sense? Hopefully it does. So even if this was like 2008 all over again and you were upside down in your house, you only have to pay off 95% of the current appraised value in a refinance or a sale. You can refinance reverse mortgages anytime, right? You don't have to move. You don't have to sell. You can just change your mind. Like, I don't want a reverse mortgage anymore. You can make monthly payments on a reverse mortgage anytime you want. There's no restriction against making monthly payments or any payments on a reverse mortgage. There's just no requirement to do it. So you don't even have to refinance if you don't want. You can just make monthly payments whenever you feel like it. They just don't have one required. So let's see. If someone owns their home free and clear or almost, they can create another Social Security income. That's where the term reverse mortgage really comes from, is if somebody owns their home free and clear and they get a reverse mortgage, now instead of making mortgage payments, they're receiving mortgage payments. So it reverses what they're used to. So you can get a monthly income, you can get a lump sum, or you can get a line of credit to access that equity in your house. So that'd be comparable like a Social Security income or something. Another twist of the same idea, they can get a reverse mortgage HELOC and access the equity only when they want to in lump sums. But a major difference is there's still no monthly payments due in that scenario ever. Is it true reverse mortgages are a great financial planning and asset protection tool? Yes, actually it is. I'm not elaborating here in the end of the newsletter, but I'm telling, so if you have questions, reach out. But yes, it is, because if you get a reverse mortgage HELOC and you owe nothing on the house, if somebody tries to sue you, for example, a car lawsuit or something like that, and they look at your house, they can tell if you own it free and clear. But with a reverse mortgage, it doesn't look like you owe it free and clear. In fact, it looks like you're way over leveraged, even if you still have a zero balance. So that's kind of cool. What if I want to serve a full-time mission and won't live in the house for a while? What are the costs of a reverse mortgage? What if I still have a mortgage? So hit me up if you have any questions about any of that. You want to run any scenarios about that or any other kind of loan. But sad to say, this is the end of the newsletter. It's just 2 pages. So now's the moment where I'm going to have to say goodbye and wish you well. And hopefully you enjoyed this little journey that we took together. Thank you for your business. Thank you for taking the time to read this and or listen to it. And please let us know if we can do anything for you. Josh Thomas, mortgage broker in Utah. Bye.